Mistakes I've made in my property investing journey. One of the key things that people don't realize when you invest in property is that the mistakes you make right at the beginning compounds itself 2 or 3 years in the future. The decision you make today could result in creating more wealth, you buying an extra property, or stagnating your portfolio. I'm going to share with you the 3 biggest mistakes that I made in the commercial property investment journey when I first started and how that's resulted in having to stagnate or slow me down in my investing journey and how you can overcome that. My biggest goal in this video is so that you can think ahead, create more wealth in the future by just tweaking and changing your perspective and your investment decision by 10 or 20% that can compound to 50 or 100% better returns in the future. My name is Helen Tarrant. I help everyday Australians become wealthy through commercial property investment, helping them to get more cash flow and retire faster. In fact, twice as fast as if they invested in residential property. So if you want to find out more about what I do, I run a company called Unikorn Commercial Property. We're a specialist buyers agency in the commercial property space, as well as education, syndication, and we have the largest group of commercial property investors in Australia that came from residential property. So let's get started. Now, 3 major mistakes that I made in my commercial property investing journey. Now, back in 2012, I started my first commercial property investment. This was a little property in North Sydney. I bought for $360,000. Now, I didn't know anything about investing in property. At that time, I looked at it from a very different point of view. I wanted it for cash flow. I didn't think of anything else. And when that property started giving me cash flow, I thought, look, I'm going to go out there and find the biggest amount of cash flow I can find. So I went out to regional areas. So 2014, 2016, I leveraged up my portfolio and I went to regional areas. And back then, look, our interest rates was about that 6%, but you could go to areas of regional Queensland, regional Victoria, regional New South Wales and get 9-10% yielding properties. And that's exactly what I did. I went out to Rockhampton, I went out to Muswellbrook, I went out to regional Victoria and Wodonga, areas like Wodonga, Warrnambool. I went and invested in those areas and I was getting 9 to 10% returns, except now, 2-3 years later, even today, if I had put that money into a different town, I would have doubled and tripled my money because I chased cash flow so heavily that I forgo growth at all costs, right? Because in an area, for example, like Rockhampton, it has been a 9% yielding town for 2 decades. When I turned up in 2016 and started investing in Rockhampton, I didn't know that. I was someone from Sydney who had no idea about the Rockhampton area. I did a lot of research, but I never compared Rockhampton to somewhere like a Townsville, to Cairns, to maybe even the Sunshine Coast. Had I put that money into the Sunshine Coast, I would have got probably 1 or 1.5% less. So I might have sat on 7 to 8% yield instead of 9 to 10% yield, as in the cash flow, but I would have tripled my money between 2016 and 2024. However, because I put my money into Rockhampton, I got very, very good cash flow. I was able to clear up to $50,000 in just one property, got lots and lots of cash flow, but very, very stagnated growth. Growth didn't really happen until about COVID, when everyone came into the market and really pushes the prices up because it was all Sydney and Melbourne investors who didn't know any better and did exactly what I did, repeated the mistake I made in 2016, except they made it in 2020 to 2022, and they pushed the price up. They bought into the market at 7% yield, sometimes even at 6% yields. As a result of that, that has pushed my property value up, but without that bubble or boom, I would have been very, very stagnant. And today, that same property that I paid $500 or $1 million for would have only probably gone up between 20 to 30% rather than doubling and tripling if I had put it into Sunshine Coast or even into areas of Townsville. So one of my fundamental mistakes that I made in the beginning was chasing cash flow to the exclusion of all else. That was the number 1 mistake, chasing cash flow to the exclusion of all else. Yes, I got a lot of cash flow, but without the growth, my cash flow wasn't able to refinance against any equity to allow me to pull out the deposit and go again. So it stagnated my investing journey. Now, I earned a lot of cash flow from my business, being in education and buyers agency, and my other portfolios that I was able to collect deposit. But if I didn't have that, if I was just purely focused on my own, in isolation, that portfolio, in regional, I would not been able to move as fast. I would have moved 3 or 4 years behind everyone else, and that would have caused me a lag in my wealth creation and building that portfolio. So that was number 1, chasing cash flow in exclusion of all else. Now I look at it as a very much overall investment strategies. So with all of our clients and students, we've been in cash flow and growth as well as uplift. We consider how one property that does maybe more cash flow and another property doing more growth can combine together to make a better investment portfolio and journey that allows you to get to financial freedom much faster. So that's number one. Number two still stems from the same story, that when I went into somewhere like Rockhampton, somewhere like Muswellbrook in New South Wales, there were great 9-10 yielding % properties, and the properties were seen really cheap compared to Sydney. I never compared it with other states, other areas to really work out what is true value for money, right? Today, we do that across the whole of Australia for our client. We take potentially a property in Brisbane, compare it with property in Melbourne, ACT, South Australia, Gold Coast, to see what is the best value you can get for money, so that when you when you invest into the property, you know you're going to have compounding growth and compounding cash flow, and that you're doing ahead of the market only by comparison. Back then, I was very one-dimensional view, looking at just cash flow, and I looked at other areas purely as a cash flow comparison. So for example, if I went from Rocky to Brisbane, I would say Brisbane's doing 7, Rocky's doing 9, Rocky's doing better. Rocky, short form for Rockhampton, Rocky, compared to Townsville, Townsville's doing 8, Rockhampton's doing 9, Rocky's still better. I never looked at the overall picture as a comparison. How much is growth in a Townsville, in a Cairns, in a Brisbane versus Rockhampton? What's the historic growth of it? What's the historic trend of that property doing well versus any other area, and the economies around the other area, and how they support the growth of different tenants, rents, and value over the last 10 or 15 or even just the last 3 or 5 years, which is really key to commercial property investing. So I urge you to consider this and do a lot more comparison when you are investing, not just in just one area, in isolation of yields, but in comparison to the overall value for money proposition that you could get investing all the other areas. And I do that now in every single one of the deals with our clients. So that is the fundamental difference, as a shift, and that's the mistake I made in the beginning that I'm now rectified in my investment journey and in the strategies I do for our clients. And then finally, number 3. The third thing that I did was I bought properties in my own name. So I didn't structure it right. So because when I was starting out, I didn't go and get all of the accounting advice. I was just basically saying, let's find a deposit, let's invest. This great thing called commercial property that's giving us lots and lots of cash flow. Why don't we just invest as much as we can? We retire on the cash flow, sail off to sunset, and so be it. Well, easier said than done, right? If you don't have a team behind you, don't have a mentor, you don't have someone to guide you. Back then in 2012, when I first started investing in commercial property, accountants, financial planners didn't talk about it. They didn't even want to know about commercial property, right? So as a result of that, they couldn't give you proper advice. I didn't know that you had to hold it in a trust. Most people buy it in a trust. They do developments in a company. They do a unit trust when they're coming together. I had no idea about that. I just went out and bought 3 commercial properties off the bat in the beginning in my own name. And then what I found was when the leases came up, when I tweaked these properties, I couldn't refinance them for the optimal value because they were in my own name. And the bank just simply didn't like them in my own name, and they prefer it in an entity where it's just much easier to swap from bank to bank and bank. I was stuck with paying really high rates, not really good loan terms, so I ended up having to sell them. In fact, I'm selling my last one now, right, that I bought in 2016. So gradually, it just didn't make sense. It didn't make sense for me to pay them down because I was seeing that I wasn't able to recycle my debt. And when you're growing a portfolio, the most important fundamental thing is recycling that debt, is to be able to have a property, tweak the leases. As the area goes up in value, your rents have gone up, you get a revaluation, your value have gone from, let's say, buying at 500,000, now worth 800,000, you're able to pull out an extra 200K, essentially the deposit you put in, you got it back, to recycle and do it again, right? You can't do that if it's in your own name. It's just very, very hard. The bank, there's only limited to 1 or 2 banks out there who will ever do the deal, and then they hike it up and give you very low LVR, which is loan to valuation ratio, so you can't refinance and go again. So I went against all of these struggles, and I just couldn't finance it to that level. And I would have 300,000, 400,000, 500,000 stuck in there that I couldn't use. It was dead equity to me. And when you're growing a property portfolio, dead equity is the worst thing that could happen to you. So basically for me, I had to sell. So I made the decision. They were great properties, great tenants, never missed rent, always able to put in a new tenant whenever one left. I just had to sell it, right? I had to sell it because it was held in a different entity. And if I moved it into a different structure, let's say I moved it from my personal name to a trust, I would have to pay stamp duty again. And for me, it was like, well, let's just sell it, get the equity out, pay a little bit of capital gains tax, and move on, right? And move on to the next deal. Maybe amalgamate 3 of your properties that you sold with a larger deposit and go and do something bigger, right? So ultimately, having the right structure and the right advice and everything set up became so important. And now I instill it in all of my clients and all of my students to make sure that they do that before we execute the contract, so we don't have to waste time in losing the deal because we've got the wrong entity, buying in the wrong entity, having to pay a lot more tax, having not to be able to flow through your capital gains. All of those things, we minimize that, and we also make sure we have the correct timing when we do the deal. Obviously, doing the deal today is very different from 2016, but if you take a leaf out of my book, these are the 3 things that you do not want to stuff up on. One is just being purely cash flow driven. Being purely cash flow driven in exclusion of all else would damage your portfolio because it won't allow you to grow. If you have residential, you can go for just cash flow and commercial. 2 will combine together, allow you to go again and again and again. If you don't, and you're just starting out with commercial, or you just have resi, you need to balance that portfolio so you have the cash flow to offset the growth so you can go again together. That's number 1 mistake. Don't make that mistake because it could really stop you from one cycle of buying, which means you miss out on a hell of a lot of capital gains as well as the cash flow growth. Number 2, not comparing the best value in the market, as in what else can I get with this money in terms of ACT, Sydney, Melbourne, Brisbane, Townsville, Rockhampton, Warrnambool, wherever those areas are, right? There's heaps and heaps of those areas, but you want to make sure you go, if I have $1 million, $2 million, $5 million, what is my best return on investment for that money, right? And you want to compare it to both cash flow growth and future potential of rental increases and everything else in that area. And if your buyer's agent isn't doing that, we certainly are here at Unikorn Commercial Property. So just, click the link below, book in for that strategy session and join us and let us help you build that portfolio, because we've got a massive community of commercial property investors coming together, doing like-minded deals, coming together for syndications, plus going to our boot camps and events, right? So that you're really surrounded with the right mentors and the right people moving forward to help you in your journey. So make sure you join one of our events or click into book in for that strategy course, because we can really help you map this journey out for you. And of course, number 3 most important thing is the right structuring for your purchase. If you get the structuring wrong, it can cost you money in double stamp duty, as in you have when you move the entities, you have to pay the stamp duty again. Also, it could cost you the future of refinancing, having debt equity you can't refinance, which is absolute killer in a property when you're doing a property investment journey or growing your portfolio. So remember those 3 mistakes. I made them. I don't want you to make them. My analogy has always been, I want to make the mistakes whenever I go to a new area, wherever I go to a new place I'm recommending to our clients. I want to go in there first. I literally invest in those areas first so that my clients don't make those mistakes, and you as my students and as part of my community don't make those mistakes, so that you can do it right the first time and having that compounding growth in the back end, because one mistake you make now can affect 30 to 50% of your portfolio journey in the future in terms of growth or cash flow. So make sure you don't. So if you want great mentorship, you want a community, you want someone who really knows at the core what they're doing and they're looking across Australia, finger on the pulse, then you need to reach out to myself here at Unikorn Commercial Property. Link below to book in for that strategy call. Join one of our events and let us help you build financial freedom through commercial property. Thank you and bye for now.